Well, good morning and welcome to the Great Transition Senior Living Seminar Series. Today's topic is how can I afford to live to be 100? We're excited to have you with us. We've got a lot of people in the room today. We've also got a group on Facebook Live that will be joining us. And so we encourage you, if you have any questions on Facebook Live, drop them in the comments. We'll get to those at the end. We thank you for being here, and we thank each of you for being here as well. As you know, Great Transitions was founded in 2013 by our good friends Paul and Lynn Henderson, and it is a system for working with seniors and their families as their lifestyle and housing needs change. You know, sometimes it can be 12 to 18 months before someone is ready for a move, or an event can happen that speeds up the process dramatically. And that's why having a plan is so important. And we're here to guide you through that entire process. We genuinely believe that helping and guiding seniors is our greatest responsibility, and it's an honor and privilege to help and care for those who have helped and cared for us. That's the Great Transition Senior Living Way. Our objective here today is to provide, and every seminar is to provide education on legal, financial, housing, medical, and all topics of general importance to seniors. We are not here to try and sell you anything. I had someone ask me that recently, like, who's going to be on the panel and what are they doing? I said, this is a sales-free zone. We're just here to provide information. Our educational partners are like-minded in that vein, and they are here to provide information and help you as well. But we do challenge you to ask yourself a couple of questions. Number one, who's going to be tasked with making the decisions for you when you're no longer able to make them for yourself? And will you agree with the decisions that they make? Have you shared your plan with your trusted advisors or your loved ones? So just something to think about and put in the back of your minds. So, how can I afford to live to be 100? It's a good question. Have you guys noticed that things have gotten a little more expensive lately? I mean, groceries, gas, healthcare, taxes. And the interesting thing is prices have risen and life expectancy is on the rise because our doctors and researchers and everybody's doing such a good job that everybody's living longer, right? So these two things coupled together bring us to where we are at today and what we want to talk about today. You know, we're all different and unique individuals in this room and our online community. There are people that are doing very well, planned well, got lucky, and are sitting in a good position. There are people that may be going through some tougher times because we've all been on a different life journey. But we're all in a position today to begin to be proactive going forward. And so we want to help you create the best plan for you. Keep in mind, we're going to be taking a broad look at finances today. Everybody's got specifics. And you know, we always say, Linda says, a lot of the medical people say, our favorite answer is, it depends, right? Everybody has their own unique situation. So that you may have some questions specific to you that you'll want to ask towards the end, or maybe even come up and ask privately after our discussion here today. Don't forget, if you've got questions as we're going, be sure to write them down so you can remember them when the time comes. And I will introduce you to our esteemed panelists. They are also educational partners with us, and so at some point you might get the seasoned question from you, but we'll get into the meat of it. To my far right is Dana Richmond. You guys know Dana. She specializes in a strategic approach and couples that with creative solutions that are tailored for her clients. She offers her clients a wide array of financial solutions that can be customized to their unique needs before or after retirement. She enjoys collaborating with tax and legal advisors of her clients so that they're all on board to ensure an appropriate and comprehensive strategy. Dana holds Series 7 and Series 66 registrations. She is originally from our state capital, Tallahassee, and earned her Bachelor of Science degree from the University of Central Florida. When she is not working, Dana loves to play tennis, dance, spend time in the Florida sunshine, and with JT, right?
Absolutely.
Yeah.
Yes, Justin Timberlake, always.
And Dana loves spending time with her family, her husband Sean, not this Sean, a different Sean, and their 2 young daughters. Now this Sean is Sean Williams, and both of them are with Evershore Financial. I didn't mention that earlier. Sean's motivation every day is to bring wide-ranging knowledge, fundamental financial philosophy, strategy, and a sense of security to help his clients and their families achieve their financial goals. Sean concentrates on creating a specific financial strategy for each client that is unique to their personal circumstance and life goals. He is a native Floridian and earned his undergraduate degree from University of Florida and his MBA from University of Central Florida. When Sean is not working, he enjoys traveling, attending sports events, and spending time with his family. So glad to have you both here today. So before we jump in, what season were you born in and how does that reflect you?
I was born in the winter, and since I've now been back in Florida, I love the winter. The winter is my favorite season here. I feel my birthday's January 5th. It tends to be like a picture perfect day here in Florida. And I totally love it. Winter in other places is garbage, but winter in Florida is wonderful.
I love that.
Yeah.
Sean, what about you?
I was born September 7th. I don't know if that's technically summer or fall.
Next summer.
Leading into fall. Really good time for me. I like attending sporting events, so right into college football season, Florida football, so it works out pretty perfectly.
Okay, all right.
I'm the tweener, I guess, season-wise.
Okay, seasonal tweener, got it. Awesome. Now that we have that out of the way, we're going to jump into the meat of what we're here to talk about. So a lot of times as we're talking with people at our even people that come to our downsizers club, they're in this place of, I got to decide where I'm going. I haven't even decided what I'm going to downsize to, right? What that looks like for me. And so that we know that there are a ton of senior living community options here in Orlando. I think we are really blessed with housing options and senior living community options. And so that's a big question, but how can a financial advisor help us with that? Dana, can you kind of take the lead on that?
I can. I think financial advisors, I think it's assumed that we are going to help with finances, right? We're going to help with the dollars and cents that you have. Doesn't really matter how many zeros are in the bank accounts, but we're going to help you figure out your plan. But when it comes to money, money is so emotional, right? Everybody has baggage surrounding their money, whether they liked how their family, handled the money, whether they don't like how their family handled the money, your spouse, and you like it or you don't, or your career, whatever. There's so much wrapped up with spending money, saving money, and all of that. So what financial advisors really do is we kind of help you with the emotional way to make money decisions and also the mathematical way, right? And sometimes those two ways of thinking don't exactly align, and having a financial advisor in the room and a part of your life can really help you find the intersection of where some of those emotional choices might align with the mathematical choices. So here's what I mean about that. Like, as it relates to downsizing or making this really large choice that might be far out or it might be more present. The emotional choices are maybe surrounding your feelings about leaving the home that you're in. You could be really excited to do that, or that could be like disheartening for you. Or you could love the idea of moving into a community, or you might feel like that is not what you want to experience in, kind of this chapter of your life, right? It could feel like you're moving back into the dorm, like, when you were going into college, right? All of those things are the emotional choices, or the idea that you don't feel that you can afford this next choice, or that it's like beneath you. You know, like these are all kind of the emotional ways to think about this change. Now, on the mathematical side, I love math. Sean and I love math. We're math nerds clothed in really cool, you know, chill vibes. Oh Lord, sorry about that. But the mathematical choices are really just helping you break down, is this something you can afford, or what can you afford? And I think when we're talking about moving into a community or downsizing or whatever it is that seems ideal for you, it's very easy to come up with, if you're a homeowner, I'm gonna sell my house for X and I'm gonna move into a community, doesn't matter if it's a rental community or a life plan community, and the monthly service fee is going to be Y, right? But there's so much more that goes into the math. Right? The monthly upkeep or the annual upkeep of the home that you own, the taxes, the pool guy, the termite bond, like all of these things are where financial advisors can really step in and help you with the mathematical choice. And that's what we're gonna kind of explore here. So financial advisors, our role is vital to help you not only with the emotional decision and how finances play a role in that, but also the math of it.
So you want to make sure you're working with someone that's asking those types of questions?
Yeah, absolutely. I mean, I think we're both in this industry because we enjoy being like part-time therapists, for our clients. And really, I mean, a financial advisor, the person that you're working with, I hope that you all feel that they're really in the inner fold of your life, because that's where we like to sit. We like to understand what's going on with the adult children or grandchildren, or we like to understand what's happening at night at home. Are you feeling lonely? We can help with that, right? Like all of this is surrounding your money. I mean, other than your health, money really is so important. And again, it doesn't matter how many dollars or how many zeros are in your bank account. It's the money that you have, and we need to create a plan to make the choices that you want to make.
Okay. Well, we're going to talk through a couple of different scenarios today and kind of maybe delve into both of those two sides of the question. Sean, I'm going to direct this to you. Let's say I know I want to go to a life plan community, continuing care community, but I also feel strongly about leaving money to my children. And some of these, the life plan communities, obviously we've got an entrance fee. Is there a way to do both? If I'm relying, let's say, on the sale of my home to provide that entrance fee?
Yeah, let me give one of our favorite answers, which you mentioned before. It depends, right, on the specific situation. But in general, the best way to guarantee that you're going to leave money to your children, grandchildren, whoever it may be, is a life insurance policy. But if you don't already have one, or it's too expensive at this point to do one, or you can't qualify for underwriting, and you're moving into a continuing care retirement community, which nailed it. That always trips me up.
You did so good.
There are options. The entry fee options are pretty robust depending on the community, but they have options where they pay your beneficiary or your state back a percentage of the entry fee. So, just for example's sake, you can do a 0% return option. You can have there's a 50% return option where half of your entry fee is paid back to your, I don't know if it's beneficiary specifically or your estate, or one of the communities can answer that question, when you pass away, or you can do a 90% return. There's other options as well. The percentage that gets paid back is usually determined by the size of the entry fee. So that's really where the decision comes in, is how much you're paying up front versus how much you want to get back. So really encourage you to meet with different communities, discuss their different options, meet with your family, and then also with your financial advisor. The best route, obviously, in our opinion, is to do a financial plan. Then you look at your entire picture as it is today, and you can just compare every option and have the numbers right in front of you and make an informed decision on what's best for you now. And then if your goal is to leave money to heirs, okay, what to expect moving forward, right? Using these different options. So it's just a way to make a informed decision on what's the best route for you. I would also say, if we're prioritizing those two things, right, we want to move into a continuing care community as part of your care plan moving forward, and we want to leave money behind, I would prioritize your care first over leaving money behind. I would assume most of your children would agree. At least your face would.
Let's hope they would.
I've had quite a few clients over the years who have had their parents go into assisted living, memory care, and they've never come out of it saying, "Oh man, I can't believe what it did to my inheritance." It's always, "Wow, I can't believe how expensive that is and all that goes into it." Even as their kids, they may help them manage it, and then that's almost always a catalyst for them to start their care plan. So there are ways to do it. It's just you've got to look at the options and figure out the best route for yourself.
So I think what I hear you saying is the gift to the children could be the gift of knowing that mom and dad are cared for.
Yeah, definitely.
Okay.
It takes some burden off of kids, right?
And is it, and that's something that you can look at any time, say, hey, here's community X, maybe it's one of the communities that are here in the room, but here are their options. Get your financial planner to run the numbers based on those.
And then we can sit down together and look at the different options, and it's right there in black and white.
Okay.
And like talking about the emotional side of it, if you had preconceived notions about, oh, I would never get money back, or I would only want all of the money back, look at the math first. Because not every option makes sense for every person, and that's why I think the communities offer so many different types of contracts, is because different people have different scenarios that they're trying to plan for. So kind of go into the process with an open mind also.
Okay. So let's say I have decided on going to a community, could be a rental community or a continuing care, life plan, life care community. And let's say I have some long-term care insurance. What's the benefit of that? Not everyone has it, but a lot of people do. How is that gonna help my money last longer?
Yeah, I think if you have long-term care insurance, you might remember when you were taking out that policy, or if you don't have long-term care insurance, you just might be a little confused as to what the purpose of long-term care insurance is. I think there's like a misnomer out just like in the world that long-term care insurance is designed to pay for every dollar of care. That is not the purpose of long-term care insurance. The purpose of long-term care insurance is to protect your assets. The care that you require is the care that you require. But if you have long-term care insurance, you're using a leveraged dollar, right? Your $1 turns into $5 of long-term care. And that's the purpose of long-term care insurance, it's to protect the assets that you have. It doesn't mean that you are going to have that every dollar of care that you are going to require is going to be covered, but you're going to spend down that long-term care insurance bucket before touching any of your other assets, right? So long-term care insurance plays a huge role no matter what you choose to do. If you remain in your home, if you go to a life plan community, a rental community, in any way, long-term care insurance is going to play a vital role. Now, certainly from the community's aspect, they do love any potential residents that have long-term care insurance when they're evaluating, all the things that they look for in terms of somebody moving in. It's certainly not a knockout if you don't have long-term care insurance, but it might be a feather in your cap, when they're kind of evaluating if you would be the right fit for their community. So those are really the way, long-term care insurance, if we could preach any gospel, and we'll talk about it more throughout our time here, but long-term care insurance plays a huge role in your choice, because you know that your dollar is leveraged.
That's awesome. And long-term care insurance is used specifically for those higher levels of care.
That's right. Yeah. It's kind of an acute problem versus a long-term care problem. So for instance, your Medicare or your health insurance is going to cover if you have a fall and break your hip and need acute care, a skilled nursing care, but for a short amount of time, right? That's not long-term care. Long-term care insurance kicks in when you cannot perform 2 acts of daily living. So it really is at the place that you really need assistance, kind of doing the things that you need to do on a daily basis. That's where your long-term care insurance kicks in. Thank you for letting me point that out.
Sure, of course. Okay, so we've talked about moving, downsizing into a community. Let's talk about aging in place, because there are a lot of people, and I know there are a lot of surveys that are coming out now that, especially baby boomers, and I think we have a few in the room, are 80% are I'm going to age in place and stay in place. So Sean, what factors should I be considering if I'm going to be aging in place versus moving to a community?
Yeah, I think most people like the idea of aging at home, right? Sounds nice. And it can be if you just have to weigh the factors of the decision like anything else. It's more than likely in the long run, could be a little more expensive versus going into assisted living or a specialized care. And obviously, like anything, it depends. Because you have to take into account things other than the cost of care, right? So like Dana said before, if you're still in your house, you've got property taxes, home insurance, you may have a mortgage, you may not, lawn care, more bigger upkeep of the house, roof, paint, all the joys of homeownership. And then as far as the cost of care, typically it's gonna be gradual, right? So maybe you start with a couple days a week for a few hours a day, and then you go to maybe 8 hours a day, and then you may get to a point where you need 24-hour care. I have some numbers for you, which is very exciting. And Melanie could correct me if this is not accurate, but from what I can gather, the average hourly rate for in-home care is $20 to $30 per hour. So for our purpose.
It's higher than that when you're.
So, okay, what the numbers I'm about to give you, just pretend they're higher.
Everything's getting more expensive, right?
Yes. So for our purposes, we'll call it down the middle, we'll say $25 an hour. At 8 hours a day, that's $1,400 a week, or $5,600 a month. If you do 24 hours of care, that's $4,200 a week, or $16,800 a month. And like Beth just said, that's not going to get cheaper. So the first part of the decision is if you have the means to do so, right? The second part of this decision is a lot of continuing care retirement communities require that you start in independent living in order to guarantee your spot in assisted living or more specialized care. So, big part of the decision is, okay, do I start aging at home and then try to move in later, or am I losing a spot? Do I move in early in independent living? It's a big decision that really shouldn't be taken lightly. Those are the two big factors to weigh in. Couple just other points. If you do have a long-term care policy, I would just review it to see if it covers in-home care, and if it does, what are the parameters around that? Because it can vary from policy to policy and what specifically in-home care means to the policy. And the second piece, there's a website that you can use that shows you the cost of care for in-home care, assisted living, and specialized care today and every year in the future based on inflation, and it's based on zip code. I'm not going to give you the actual web address because it's really long, but just Google Genworth, which is GENWORTH, cost of long-term care by state. And then you just put in whatever zip code and it'll project.
And we can we'll put that link in when we send you the follow-up email, we'll be sure to put the link in there.
Okay.
So that could give, even without going to my financial advisor, I could get a look at,
Just what the expected cost is to be in the future based on where you want to live
okay.
and the type of care you want.
Okay. Great. Anything else relative to aging in place?
That's all I have.
Okay, that's fine. So, I wanna hop back to long-term care insurance for just a second, because that tends to be a hot topic. Let's say I didn't move forward with it for one reason or another, and I'm in the process of shopping for long-term care insurance right now, and it's like I have to pull the trigger on it, right? And, but let's say we need to do that. Is there a point at which it doesn't make sense to get it? And if I can't qualify for long-term care insurance, what options are there? Sean?
Yeah, so I don't think there's a scenario where it doesn't make sense to at least explore what options you have. Like Dana said, it's about leveraging your money. The long-term care industry as a whole has changed quite a bit in the last 10 years or so, because there is such a massive need, not only now, but expected in the future for long-term care. And that's created competition between the insurance companies, which is typically good for the consumer. So long-term care insurance policies themselves have gotten a little stronger, but there are also options if you can't qualify. The options that say you can't qualify for traditional long-term care, insurance companies have annuities with long-term care riders attached to them, where there's no underwriting required. The only question is if you're already in care or not. So if you're not, you can qualify. They may not create the same pool size of pool of money. That was a good sentence. As a traditional long-term care policy, but they have guaranteed growth factors built into them. So at least we have money that is designated and set aside for long-term care that is growing. The really only factors into that are your age. So some have a max age of 75 for issue, some have a max age of 80 for issue. So if we're beyond those ages, then it's really, I think, back to the same thing I've said a few times now, is doing a plan to see, looking at your complete financial picture to see if there's a piece of your assets that we can carve out specifically to set aside for long-term care. It may not be in a long-term care policy or an annuity, but at least we have that piece of the plan accounted for. And it's an important topic to not procrastinate on, because if you wait too long, you might lose the opportunity, and the longer you wait, the smaller the pool of money is going to be. So it's important to start planning now as opposed to waiting.
So if I'm 72 years old, I can still look into it?
Definitely.
Okay. Alright, cool. Now we have some people in the room that are caregivers. And that brings some different focus points also. Dana, can we talk to the caregivers in the room a little bit?
Yeah, absolutely. From a caregiver perspective, we're going to stick to the financial part of it. So from the financial perspective, I think there just constantly has to be a real honest evaluation of where the person is that you're caring for, and also what the future looks like from the care that they are going to require. Is that in your scope of being able to handle by yourself? Or do we need to be looking into other options? Where is the person that you're caring for going to be best served, right? And so financially speaking, do they have long-term care insurance? If they need specific memory care, have we looked into those types of communities that provide those types of services for the person to keep them as safe as possible? Our roles as financial advisors is to highlight also the caregiver and what their needs are going to be financially speaking. We're not naive to think that a spouse is not going to use every dollar possible to provide the care for their spouse, right? But when the person requiring more care passes away, what does that look like for you as the caregiver? We cannot forget the remaining spouse or the remaining person. So does that look like, it might not make sense to get long-term care insurance for someone already that requires great care. But the healthy person providing the care, maybe long-term care insurance is the perfect route so that when they remain, they're taken care of. Again, it's a healthy balance of we understand that every dollar is going to be there to keep them comfortable, but we just don't want to forget the person that's providing the care now and what care they themselves will need, later on. So it's a healthy balance, but again, I think it takes we're talking about the emotional side of financial decisions and the mathematical side, and it really just takes a very honest assessment of where we are now and what the future looks like for both parties.
And that could be a very hard conversation to get started.
Very, very hard. That's yet another reason why you need a trusted person helping you with these choices to be able to say, hey, this is not going to be a fun conversation, but we have to explore this because there are two people in this scenario, and we need to make sure that one person dies first, right? That's statistically speaking how things go down. And so for the remaining partner, they need to be able to live their life too and do that in some form of comfort. And so it's not that we will have all the answers, but we will figure out a plan together to make sure that we're balancing both parties. Not fun.
And I think a lot of what we talk about in our seminars, whether it's this or like the legal paperwork, those are never fun to do. But I think once you've talked about it and created a plan, there is a lot of peace that comes
Absolutely.
with that.
Yes.
Now this next question could be a whole seminar and unto itself. What about Medicaid? How does that factor into all of this, Sean?
Yeah, so every government program, Medicaid can be a little confusing. There are different types of Medicaid, all focused specifically on long-term care Medicaid, but Medicaid as a whole is there to provide health services and other services for those who are economically disadvantaged. So in the state of Florida, for long-term care Medicaid, there are income limits and asset limits to qualify. So I've got some more numbers for you. For nursing home care, if one person is applying, one person is applying, you have to make less than $2,829, very specific number, before taxes a month. So it's about a little under $34,000 annually. And there's an asset limit of $2,000, so it's a low asset limit. And if you're a married couple and only one person is applying, the spouse's income does not count towards that limit. If you're both applying, those limits go up. So if both spouses need Medicaid for care, the income limit is $56.58 a month, which is about $68,000 a year. That's not too bad, but it's the asset limit again that is pretty low. It's $3,000 in assets to qualify for Medicaid. So it's not the easiest thing to qualify, and that's nursing home. There's also, if you just need assisted living to help with activities of daily living, then it kind of flips. Now the income limit is really low. I would imagine most couples' Social Security is above that limit. For one person, it's $1,104 a month is the income limit. Yeah. Then the asset limit is $5,000. If both spouses are applying, the income limit is $1,492 a month. So it's low for, I imagine a lot of people's Social Security is going to be higher than that. And then the asset limit is $6,000. So now some good news. In the state of Florida, IRAs that are in a state, how do they define it? Payout status. So that just means you're taking required minimum distributions off of your retirement accounts. Those assets don't count towards the asset limit. So that helps a little bit.
You have to take them monthly though, you can't take them annually.
You can. It's just if you're in that status where you're forced to take the
That's
distribution.
The option has to be a monthly payout.
Are you saying that you know that for sure? Is that a question?
Yeah.
Oh, really? You can't do it annual?
Yeah, then your IRAs count.
Interesting. Good to know. Okay, so you have to be taking monthly distributions. The primary residence value also doesn't count towards asset limit. Another thing to keep in mind is Florida has a 60-month look-back period with Medicaid. So what that means is you can't gift or transfer assets or sell assets under fair market value within 60 months of when you apply for Medicaid. So it's 5 years. Yeah. So that's there to prevent people from trying to hide assets or move money around to qualify for Medicaid. So it can be difficult to qualify for depending on your scenario. Really, the plan's not going to be, hey, let's qualify for Medicaid. It's not going to be the goal, but if that happens, it is there to step in. Like what Dana was talking about, having someone trusted involved in all this. There could be, if you get to Medicaid or a point where you qualify for Medicaid later in life, and you're in more substantial care, you may need somebody else to help with the whole applying for Medicaid, and there's annual reviews, and so you should have a trusted partner or spouse, child, whoever, to help with this as well. Because like I said before, anything with the government's not really that easy to deal with process-wise. So it can factor in, try to avoid, obviously if possible, but if it's there, it's needed.
Awesome. Well, thank you. And maybe that's a topic for discussion at a whole other time, because I think you could go down a lot of rabbit holes with
Yeah,
that.
for when it comes to like Medicare and Medicaid, there are other specialists who specialize in that topic. Usually outsource it once it gets to a certain level to a trusted professional. But
Again, having the right all-star team is super important.
right.
Yeah. So, Sean, let's stay on the money side. How can we plan for our money to stay ahead of inflation? We know that there's also going to be increases in either monthly dues or rent if we do go to a community. How do we make the money last or keep pace with that?
Lots and lots of lottery tickets. There's always going to be some level of cost increasing. Over the last couple of years, inflation's been much more in our face on the news and firsthand with that said, food, energy, insurance. That can be scary, especially if you're in the non-earning phase of your life, where you're not earning an income and costs are going up. That can be scary. Good news is inflation has normalized somewhat over the last 12 to 18 months. Probably still a little higher than most would like. We were a little spoiled. We had a 20-year stretch of super low inflation. But that's a rambling answer to get into the question. What we do with retirement planning is we'll look at different buckets of money, right? So pieces of your assets that have different purposes. First bucket is going to be your guaranteed income. So Social Security, pensions, if you have an annuity with an income rider, VA benefits, money that we know is coming in no matter what. Social Security and I believe VA benefits are the only ones that are going to adjust for inflation on an ongoing basis. Annuity and pensions, those won't change. So your guaranteed income, then we look at your living expenses, and then we see, okay, what's the gap between the two? And then how do we fill that gap? So first bucket, that's not really designed to beat inflation. That's just our safe. We know what's coming in, we know what's going out. Second bucket is going to be low risk, cash, maybe a year for big bills, emergencies, maybe dividend interest, things like that. Things that also really aren't going to be beating inflation. They're low risk, liquid. So first two buckets, right, we're not beating inflation more than likely. So you have your third piece, which that's going to be the more growth oriented piece of your assets. Some more numbers. Our average inflation for the last 100 years is 3.3%, which is about what we're at right now. And there really hasn't been a period of really high sustained inflation since the 80s. We obviously just had that 12 to 18 month higher period. So if we're using that number, and all we have to do is beat, we'll say 3.5% with that growth piece of your assets. I can't guarantee anything legally, but I can say pretty confidently, a relatively conservative portfolio will beat 3.5 or keep up with 3.5% on the long run. Problem is, we're not just keeping up with inflation, right? If we're using this piece of your assets to help either supplement that gap between your guaranteed income or in your expenses, or we're going to use it later for long-term care or something along those lines, we need to be keeping up with rising costs, but also the withdrawal rate out of the portfolio in order for it to sustain itself. There's a very general 4% rule where you can take 4% off of your portfolio annually to have it sustain over a very long run, like 20 to 30 years. So it's a general rule. It's going to be more specific to each person, right? Depending on the time horizon, the amount needed, the size of the assets, all that fun stuff. But it's the portfolio versus inflation plus the withdrawal rate. So you have to have some level of growth, and to do that, you have to have a little bit of risk as well. So the third piece is going to have a little more risk exposure than the first two pieces. And in order to do that, you've got to be in the stock market, bonds. I'm not saying we're going to go 100% and live and die by the NASDAQ every day, but you have to have some exposure for growth, and then try to manage the level of volatility on a year-to-year basis. Because it's never going to be, hey, we're getting 4% every single year. We can try to average that over a long run. So you try to limit the volatility as much as you can, but you just have to have something that can grow. When it comes to investments, people look for three things: growth, liquidity, and protection. There's nothing that exists, at least that I know of, that covers all three of those things. Usually you can do two. So in this scenario, you have growth and liquidity. Can't guarantee protection, but you have to have some risk to get growth. So you've got your safe piece, and you've got your, still could be relatively safe, but your piece that's designed to try to beat inflation.
So having that diversity is going to help to insulate you.
Well, yeah. I mean, let's say if you have $100,000, you're taking 7% every year. That'll last 10 years without any growth.
And you may have other types of investments like real estate or something
Sure.
in that portfolio as well that are gonna, again, diversify all of that. Yeah.
I think as financial advisors, we sort of cringe when we hear the buckets term. You gotta have your buckets, but there really isn't another way to describe it as well, right? So what Sean's talking about is just having your buckets, and they all have a different goal attached to them, and they're all designed to do something different for your life.
Because if your bucket is the mattress, it's not gonna accomplish a whole lot, right?
And you're definitely the student.
Right.
For sure. Might sleep well, but for a little while anyway. So, we have talked about some heavy stuff today. This was like
This wasn't fun?
it was great fun and a lot of numbers. I have a marketing degree. I do not have a finance degree,
I
so.
actually left out a whole thing I had about aging statistics, so you're welcome.
Oh, thank you. Thank you very much.
I pulled it back.
And so, like, this whole financial piece is like, huh. And then the prospect, but it's made better with people like you. And then the prospect of downsizing is, huh, right? Heavy also and overwhelming because there's so many things to consider and discuss. What steps can we take today to maybe alleviate some of this overwhelm, break it out, make it a little bit easier to digest? Dana, can you leave us on a happy note?
Hi. Obviously it sounds self-serving, but we truly believe with a financial plan, you will feel empowered, you will feel confident, you will have that peace of mind that you mentioned earlier, because there's direction. It doesn't really matter what's happened in the past financially. We're here today, and we have somewhere we want to go, right? And we're a financial advisor is really there to kind of help you navigate. We were talking about essentially what Beth just said, like, oh my God, this topic and this conversation is going to be a lot for people. How can we kind of help them? And Sean came out with a brilliant analogy, like brilliant. So bear with me. So, you know, like if you're going somewhere and you haven't been there before, you feel a little uneasy if you don't put Waze on, or if you don't put your navigation on in your car, right? You're just like, oh gosh, where am I going? And you're gripping and the music's down, you know, and all that. But if you put on the navigation, all of a sudden you're a lot more confident with finding this place that you've never been before. You all have never gone through these choices before. Luckily, we feel luckily, we get to help our clients, and all financial advisors out there get to help our clients with these really large choices day in and day out. So, like, we're the navigation. Financial advisors are the navigation. It's not to say that we won't, you know, you're not going to hit a rainstorm at the exact moment that you need to get to the new doctor or whatever, or that there's not going to be traffic along the way that's like a total bear. But there's just more confidence when you have a plan and you've thought out a good plan for yourself. There's just going to be more confidence, and that's not only with yourselves, your spouse, your best friend who you guys are doing this with, but it's also with your family, right? And it doesn't have to be a financial advisor that helps you with this. We believe that that's exactly our purpose and our role, but it can just be whomever you think of as your team, helping you through these big choices, not only the emotional side of it as it relates to money, but also don't forget good old math, right? It does lead you in a good direction if you actually sit down, you know, with a calculator and try to do it. And we're not talking like long division or anything, just a basic addition and subtraction will go a long way.
Awesome. Well, thank you. And that reminds me, there's a coach that I listen to every day pretty much, and he says your greatest superpower is the ability to ask for help, right? And so thank you for being a resource for us to do just that. And with that being said, we have some time for some Q&A. So I think our educational partners have the microphones back there. If you have a question, does anybody have a question? Okay, I think we got a few. All right. So raise your hand so let's continue. Richard, we'll take your question.
Yeah, I'd just like to know, since you have all this experience with all different clients of different economic status, you must have in your mind, if someone were to decide, okay, I'm moving to these senior living houses, places, and I'm going to do that when I'm 75, and I think I'm going to be 100, what is a good, comfortable amount of assets that you would feel, hey, no problem? You're talking about $1 million, $2 million, $10 million.
That's a
must be a ballpark that you say, oh, we can deal with this, no problem. What number is that?
That's a great question. What is the magic number if I'm 75 years
Right, we
old?
all want a magic number. Okay, so, right. Okay, so I would love to give you a number, right? But this is it depends type thing. Because there are so many communities to serve so many people's needs, right? From the Rolls Royce to the Honda, right? But a good general rule of thumb as it relates to life plan communities, rental communities are going to be different when we look at this, and we can talk about that in a moment. But from a life plan community, generally speaking, they like to see double the entrance fee in assets. So for instance, if the entrance fee is $100,000, they would like to see double that in assets that you have, so $200,000. And on the monthly services fee, they would like to see double the monthly services fee in income. So if the monthly services fee is $3,000 a month, they would like to see that you have $6,000 a month in income. Does that help you as just a kind of some numbers out there, but still giving it depends answer? Okay, that's from the life plan community. From the rental community, it's a little easier because, you know, just you need to understand, can you afford the monthly rent or the monthly services fee? From the switching back to the life plan communities, a lot of them have benevolence funds in place. So when they accept new residents, they are accepting those new residents for life, regardless of if you spend your assets down, i.e., if you live longer than anticipating from a financial perspective, you are being cared for through the remainder of your life. That is not the case on rental communities. It would be as if when you were in your early 20s and you were living in an apartment complex and you didn't have rent, they would say, see ya, you know, if you can't pay rent. So I hope those are little helpful nuggets. But, you know, looking at your whole entire financial picture is what you need to do when really looking at these types of things. Sort of answered. Sort of answered an it depends question.
Yeah.
Yeah.
We have another one.
Based on our experience, the long-term health care plans are a huge disruptor to steady increases and anticipations of how you're gonna live to 100 when they're under siege from their, they made a mistake and didn't realize people would live this long and a lot of other things. And in our situation, we have seen them come back to us and make increases multiple times. And unlike, we talked about 3.3% increases for inflation, and we talked about other things, they are seeking every increase that they can get. They're talking to us about 97% increase. 97% increase. And we're not getting much help from the state when we talk to the state about this. So how can you safely depend upon long-term health care?
So that older policies that were put in place 10, 20 years ago, yeah, the actuaries for these insurance companies did a pretty poor job on expected future costs, which is why they're having to raise the premiums now. Newer policies are not really, most of the ones that we use are not ongoing premiums forever, so it's a little different now, but 97% that's remarkably high. I've never seen that before. The state has to approve it also before they implement it. And usually what happens is, so like I know John Hancock, for example, if you had John Hancock long-term care policies had a 3-year rate increase to premiums for, that's approved by the state, and then the deal is after like, next year's the last increase, they can't have another increase until 2029, which I'm assuming they probably will. The problem, I guess the decision there is you've already put this money into the policy. Typically the policies are still going to be pretty strong benefit-wise, and they give you options, right? Do you mind me asking what company that is? It's got the 97.
I'd say again,
What
company is
company?
it in the 97?
Genworth.
It is
Gotcha. It's Genworth. So yeah, Genworth did a very poor job. They actually they got completely out of the long-term care game and sold their insurance business to a different company. I would be surprised if the state approved that, because the state steps in that kind of thing. But it's just looking at, they'll provide you options typically. If you don't agree to the increase, there'll be option B, option C, option D, typically lower your benefit. I actually do this quite a bit, that's what I know about John Hancock increases. It's about just looking at the options like anything else and deciding what's going to do the best fit for you long term. Usually just giving up on the policy is not the best option because you've already put this money into it and it does provide a benefit. But you can do like a no premium increase, but it'll lower the benefit amount, things like that.
So
I don't know if that answered your question.
there are some.
Talk later.
Okay.
Okay, got one over here and then a couple towards the front. Go ahead, Judy.
I don't have a question, I just want to tell everyone that you need to go see a financial advisor. I have always thought I would live, in age, in Hope, and I like where I live, it's a condo, 1,000 square feet, 2 bedrooms, close to everything. Well, thanks to the legislature, our HOA dues went from 400 to 800 a year, or a month. And I said, huh. So the ball's in my court. Do I maybe get some kind of a reverse mortgage or something? What am I going to do? And I've had this financial advisor since 2017, so he knows all of my money. And I called him up and I said, I need to talk. I need to help you. I need you to help me think it through, because there's a point where I'm not sleeping at night because of all the options. And he said, fine. What you do, come in, but I ask that you go through your checking account and you bring in a list of all of your expenses and all of your revenue. But then he said, I want to know what were the big things. I said, you mean like I had to buy tires last year? He said, yeah. And I said, like I had to go to Iowa for a funeral? Yeah. He said, I want to know those things. And I said, like the $1,500 fee assessment we had? Yeah. So it was a real Dutch Uncle talk. And he put everything on the board, and he said, well, why do you want to stay where you are? And I said, I just do. And we went into that. And he said, what's your other alternative? And I said, well, I've been looking around and I have looked at a couple of places that I might go to move into, but I think that I would need a rental because some of the buy-ins or the non-rental. He said, okay. And I identified which one I was looking at. And he said, okay, here's the tough talk. He said, Judy, you cannot stay where you are. How many fee assessments of $1,500 a year are you going to be able to afford and stay in your place? How many times are the HOA dues going up? Are you going to be able to afford it? And he said, I know your money. He said, you can't. You've got to move.
So I like that he talked to you about the burdens of home ownership and how that comes into play with your decision making. And I think your advice is wise, that we all should seek out a financial advisor.
So
We
he left.
didn't plan for it or anything.
I know.
So he left me with several things to do, and that is to look at the place where I might want to go and make that first contact and go talk to them. Then he said, if by some chance you end up with a cash sale on your condo, you're going to need a real estate attorney. He said, just identify them, you know? And so he gave me some things to do, and I left, and I felt just really good about it. I had the financial papers and the filling out for the rental place, but it's comforting to go see the financial advisor, have that talk, maybe hear some things you don't want to hear, but you will go away feeling so much better, and your head will be clear.
Thank you. Appreciate you sharing that. I think we got a couple questions to get to. Elaine, I know you had a question, and then we'll get to you, Joey.
So, my question might actually kind of be on top of her, which the story that she's telling us, but I'm thinking, when you start with a new client, that client is probably able to participate in developing their plan, and, you know, they may be able to participate for many years in modifying that plan and so on. So when a client gets to the stage where they're no longer able to participate as a financial advisor, what is the role that you play at that point in time? Especially if there's not like close family or someone that you need help with that.
That's a great question. What happens as I age and maybe I don't have family or trusted advisors? How do you manage my money?
So
Planned for that.
Yeah.
Is the short answer.
when it comes to the money side of things, you've got to have a power of attorney. Otherwise, you can't do anything. Never personally dealt with it, but it's just usually what's happening is when they're getting to that stage, they can't participate in the plan because up to that, we can't do the plan without your participation. It's your plan. We'll have a child, or even if it's over Zoom, or spouse, close friend. You know, it's common people bring their friends in just so they have a second pair of eyes on things. So you have us who knows the plan, client, and this third party, this trusted party. If you don't have a trusted party, we would have had a conversation ahead of time of like you have to have certain things in place, otherwise everything's just gonna be frozen, this plan doesn't really mean anything. So it's just having a conversation ahead of time.
And there, well, I know we've talked with Linda before about people that actually do that.
Yes.
So you would like go through the interview process with a
Yeah, if
personal
there's,
representative?
right, if there's a personal representative in place, meaning that our client does not have a spouse or adult children or family, whatever. There's not somebody in that close interweb.
Sometimes they don't trust.
Right.
Right?
Totally. And by using us, it's our role to understand nuances, right? I mean, every family is so different. Lots of times we will be having a conversation and we know that we have 2 beneficiaries listed, and then all of a sudden we learn there's 3 children, and then we need to understand that, right? And that's something that we can't shy away from and just be like, yeah, that was strange. That, we need to be very forward in our questions. Hey, you just mentioned that you have 3 children. We have never heard about 3 children. Can you please explain to me what's happening here? Because if something were to go down, our phone number is like everywhere, right? And we will get those phone calls. Again, just like Sean said, power of attorneys have to be in place. If a personal representative is already in place, we have engaged, the personal representative's role is to engage in all aspects of their client's life. So we would have already had that, we have the paperwork on file, so that when something goes down, it should go as smoothly as we have planned for. Does that answer your question?
Okay, we have Joan will have a question first, and then Francine, if we have time, we'll come back to you.
I have a question about the clawback that Medicaid does after someone who's been on Medicaid dies.
What about it? There's a clawback?
I believe there is.
So, are you talking about special needs trusts and?
No, I'm just talking about being on Medicaid for a long-term care.
Oh, if you have assets, you pay Medicaid back. It's not an overwhelming specialty of mine, but my experience with it is through a special needs trust. There are different types of special needs trusts that have different codes. One code is when you pass away, the assets that are owned by this trust pay Medicaid back. And then either there's nothing left from those assets or there is, and then there's a different type of special needs trust that is not required to pay back Medicaid.
So we would need to talk to one of those specialists,
An attorney.
an attorney, on something like that. So that's kind of out of our
Good.
purview today.
I'll talk to Linda this week.
Okay, there you go. Linda Solashri will have the answer for you. Francine, we'll take your question, and then if anyone has a question after Francine, you just have to come up afterwards and ask me.
Just a question. With regard to the financial advisor, when you're in the process of hiring your person to establish a relationship. So what happens when your person decides to either retire young, even though you decide to spend more time with your family? What's the relationship within your company with your other people that know my accounts?
Oh,
Great
that's a good question.
Great question. And certainly we are not here to sell ourselves or our firm at all, but we can speak to, what we do with that. In general, just like Sean and I partner with our clients, that is not just because we like to dress the same way and we're fun. It's
How
also.
many of you noticed that?
I know, sorry. When you see us stand up, it is like, whoa. But it's also very practical, right? We have 2 brains working on our clients. If one of us is traveling or when Sean wins the lottery, because he plays it more often than I do, and he pieces out, our clients can ride off into the sunset, with me and whomever else I breathe in. So, that is from a a larger global scale, when you are interviewing financial advisors, obviously making sure that they're licensed, that's like bare minimum, understanding the licenses that they can hold and what they can do for you, really important. Also, it might be that you don't want to go with an independent financial advisor. You want to be with somebody that works for a firm and that has other colleagues so that we can do some succession planning and stuff like that. Certainly when it comes to retirement and things, that is thought about so far in advance in our industry, and different advisors are brought on into the team so that they can get to be a part of their clients' lives for years prior to somebody stepping back. But those are all really great questions to understand.
So myself and another advisor who's our age, we've been working with an advisor who's now turned 74 in August. We've been working with him for 5+ years now, and that's his succession plan for his clients. He's been in this industry for a very long time, has a lot of clients, and he's not just gonna, disappear on everybody. Everyone's money is important, right? We're not gonna just say bye. So we've been slowly transitioning us, getting to know his clients, working with his clients, and he's essentially, he won't say he's retired, but he's pretty much retired at this point. That's how he built the transition for his clients.
So you don't be afraid to ask your financial advisor, what's your succession plan if you win the lotto and decide to go live overseas or whatever.
Totally.
Awesome.
Totally.
Awesome.
Work.
Well, thank you both. This was very insightful and lots of good information. I think I really enjoyed it and learned a lot, and I hope that you all did too. Did we try and tell you anything? No. All right, good. But now I do have a question. Make some notes on that white sheet of paper. What are you going to do with the information you got today? Maybe it's just a checkup to make sure that you planned correctly, right? But give yourself some homework and hold yourself accountable. Don't forget about the blue sheets, the survey. We would love your thoughts, feedback, any other questions that you have, future topics that you'd like to see covered. That helps us out a lot. Our next seminar is going to be July 24th. That's the 4th week, I think, in July. We had to move it a little bit later because of some things here at the chamber. And we're going to be talking about living with dementia and Alzheimer's disease. So if you'd like to go ahead and pre-register for that, you can do so on the blue form, or you can always call us or register online. And we love to close with a quote every time. Thomas Edison said, "Good fortune, or good fortunes, is what happens when opportunity meets planning." So, I hope your homework talks about planning and opportunity, and we look forward to seeing you all next month. Thanks so much for coming.